Chapter 6: Important Reversal Patterns. In our discussion of certain deficiencies in the Dow theory from the point of view of the practical trader, we mentioned the fact that it did not tell us what specific stocks to trade in. EN9, obviously, no longer a problem, as the investor may buy the DIA and trade the average like a stock. A conservative and wealthy investor, more interested in safety than maximum profit, can solve this problem by making up a comprehensive and thoroughly diversified list of sound, well-seasoned blue-chip issues and handing his broker an order to buy the lot when the Dow theory signals a bull trend. Some of his selections will do better than others, some may go sour, but wide diversification will ensure he gets a fair average result. Better results should be obtained if we can find a way to select for purchase the most favorably situated issues at any given time and can manage to sell them promptly and switch to others whenever the prospects for the first have been fully discounted. There is the possibility, too, of increasing our gains if we can, at times, buy with safety earlier in an uptrend than the Dow theorist does, and sell before the market has reacted far enough to give a Dow bear signal. We mentioned also the fact that the Dow theory is of little or no assistance in trading on the intermediate trends. There is obviously more money to be made if we can get the benefit of each up move without having to write off some of our profits in each reaction, or, if we can profit both ways by trading on both the long side and short side of the market. Finally, although all stocks tend to move with the market as typified in the averages, there are, in fact, wide variations in the price paths of individual issues. An average, after all, is just that, a device for expressing in one figure diversity of other figures. A primary bull market ended in the Dow Jones Industrial Average on May 29, 1946, but United Airlines registered its highest price in December 1945. General Motors saw its peak in January 1946, Goodyear in April, DuPont in June, and Shanley in August. Is there a way of capitalizing on these divergences? Technical analysis of the charts of individual stocks definitely answers the first and most important of these four problems. The matter of selection, it frequently, but not always, gives us a running start on the Dow theory. It also, in large part, takes care of the question of the intermediate trend, although there are certain reservations as to policy and risk in connection with both these points that will be taken up in due course. Finally, careful technical analysis should, in nearly every case, get us out of a stock that tops out ahead of the averages long before it has suffered any considerable decline, often in time to transfer funds to other issues that have yet to complete their advances. Just as the averages constantly discount all known and foreseeable factors affecting the future of security prices in general, the market action of an individual issue reflects all the factors affecting its individual future. Among these factors, and expressed in its chart, are the general market conditions that influence all stocks to a greater or lesser degree, as well as the particular conditions applying to the particular stock, including the operations of insiders. Let us assume right from the start that you, the reader, are not a member of that mysterious inner circle known to the boardrooms as the insiders. Such a group is genuinely entitled to, 41, be called insiders, thoroughly informed on every fact, figure, and development that might determine the fortunes of a certain corporation may exist from time to time and may influence the market price of its stock, EN9, and wind up in prison. But it is fairly certain that there are not nearly so many insiders as the amateur trader supposes, and that they do not cause 1/10 of the market movements for which the public blames them. It is even more certain that insiders can be wrong. They would, in fact, be the first to admit it. Frequently, their plans are upset by some development that they could not foresee or by some blind force that puts to scorn all expert estimates of value. Any success they have, however, can be accomplished only by buying and selling on the floor of the exchange. EN9, no longer strictly true. Insiders sold stock to their companies in the Tulip.com bubble, which went unreported publicly for up to a year. Still, only an isolated problem. They can do neither without altering the delicate poise of supply and demand that governs prices. Whatever they do is sooner or later reflected on the charts where you, the outsider, can detect it, or at least detect the way in which the supply-demand equation is being affected by insiders' operations, plus all other prevailing market factors. So, You do not need to be an insider to ride with them frequently. Important reversal patterns. Stock prices move in trends. Some of those trends are straight, some are curved, some are brief, and some are long continued. Some are irregular or poorly defined, and others are amazingly regular or normal, produced in a series of action and reaction waves of great uniformity. Sooner or later, these trends change direction. They may reverse, as from up to down, or they may be interrupted by some sort of sideways movement and then, after a time, proceed again in their former direction. In most cases, when a price trend is in the process of reversal, either from up to down or from down to up, a characteristic area or pattern takes shape on the chart, which becomes recognizable as a reversal formation. Some of these chart pictures are built and completed quickly, whereas others may require several weeks to reach a stage at which one can surely say a reversal of trend is definitely indicated. Speaking in broad generalities, the greater the reversal area, the wider the price fluctuations within it, the longer it takes to build, and the more shares transferred during its construction, the more important its implications. Thus, roughly speaking, a big reversal formation suggests a big move to follow and a small pattern, a small move. Needless to say, the first and most important task of the technical chart analyst is to learn to know the important reversal formations and to judge what they may signify in terms of trading opportunities. There is one recognized reversal pattern that appears and is completed within a single day's trading, and is, in consequence, named the one-day reversal. At times, it has great significance, such as calling a halt, at least temporarily, to any up or down move, but in its ordinary manifestations, it does not imply much of an immediate move in the opposite direction. It is a useful pattern, and we shall have more to say about it later, but the price formations from which extensive new trends proceed take time to build. One does not bring instantly to a stop a heavy car moving at 70 miles an hour and, all within the same split second, turn it around and get it moving back down the road in the opposite direction at 70 miles an hour. Time required to reverse the trend. We do not need to lean on a racing automobile analogy to explain why it takes time, and volume and price action, to produce an important trend reversal. The logic of it is plain enough if we take but a moment to examine it. We can do so most easily by describing what might have, and, doubtless, many times has, happened in specific terms. Suppose a certain well-informed and well-financed coterie, EN9, a congery of mutual funds, for example, decides the shares of a certain company, now selling around 40, are cheap, that this company's affairs are progressing so satisfactorily that, before long, it will attract the attention of many investors and that its stock will be in demand at much higher levels, perhaps at 60 or 65. Our group realizes if they manage their market operations skillfully, if nothing unforeseen intervenes to upset their calculations, they can take 20 points out of the situation. So they proceed to buy in all offerings, going about this business as quietly as possible, until they have accumulated their line, which may run to several thousand shares and represent practically all of the current floating supply of the issue. Then they wait. Professionals become suspicious and the rumor circulates that there is something doing in PTQ, or other canny bargain hunters discover the company's bright prospects, or chart analysts detect the signs of accumulation in the stock's action. Buyers now find the stock is scarce. There are few offerings on the books, and they have to raise their bids to get ITA and advance starts. The up move gathers momentum as more and more traders are attracted by rising prices. It is helped along by the good reports, higher earnings, increased dividend, etc., which our group knew were to be expected. Eventually, prices approach the level at which they had planned to take profits. But this operation, the distribution of their holdings, may require even more patient and skillful handling than did the accumulation. Suppose they have 20,000 shares to unload. They cannot throw all of the shares on the market at once. Doing so would defeat their own ends immediately and, perhaps, permanently. They must feed their line out little by little, trying to avoid attention, feeling their way along and never permitting a surplus of offerings to kill the demand. If activity in their stock has reached a level of, say, 2,000 shares transferred daily, they may be able to dispose of 500 shares a day from their holdings without bringing the price down. They will be competing, sooner or later, with others who have followed their play, bought lower down, and will be ready to take profits as soon as the advance shows signs of weakening, so they start to sell when the rising trend appears to have attained maximum momentum, or as it nears their price objective, but well before it has reached its probable limit, and they push out their shares as rapidly as buyers will take them. Before long, as a rule, before they have distributed their entire linear lull in demand will occur. Perhaps prospective buyers sense the increase in supply. A reaction develops. Our group quickly ceases selling, withdraws its offers, and perhaps even buys back a few shares to support prices if they threaten to drop too far. With supply temporarily held off the market, the decline halts and the advance resumes. Our group lets it proceed this time until it carries prices into new high ground. This reassures other holders and brings in more buyers. As soon as the pot is once again merrily boiling, distribution is started anew and, if the maneuver has been well directed, completed in perhaps 2 or 3 weeks, before the second wave of demand has been exhausted. Our group is now out of its stock with a nice profit. Its 20,000 shares have passed into other hands. If they gauged the market correctly and distributed their line at a price about as high as the situation would bear, demand will have been satiated for a long time to come. Prices will probably first drift back to somewhere near the level at which they were supported on the previous dip and then rally feebly on the strength of a little new buying from traders who were waiting for just such a minor reaction, meet sales from other traders who failed to seize the opportunity to take their profits on the preceding volume top and are now anxious to get out, and then break down into a decline of intermediate or major proportions. You can see now why, under one specific set of circumstances, a top area, a chart pattern of distribution, takes time and volume to complete. Nevertheless, it does not matter whether we have to deal with the highly organized operations of a single group of insiders or of an investment syndicate or, as is more often the case, the quite unorganized activities of all the investors variously interested in an issue. The result is pretty much the same. Distribution, which is simply Wall Street's way of expressing the process of subtly overcoming demand, takes time and a change in ownership, turnover, of a large number of shares. And it is amazing to see how these patterns of distribution, which hereafter we shall find it simpler to refer to as tops, tends to assume certain well-defined forms. Most of the same pattern forms appear also as bottoms, in which manifestation they signify accumulation instead of distribution. The head and shoulders top formation. If you followed closely and were able successfully to visualize how the foregoing example of distribution would appear on the chart, you saw a head and shoulders top formation. This is one of the more common and, by all odds, the most reliable of the major reversal patterns. You probably have heard this pattern mentioned, as many traders are familiar with its name, but not so many really know it and can distinguish it from somewhat similar price developments that do not portend a real reversal of trend. The typical, or, if you will, the ideal, head and shoulders top is illustrated in diagram 6.1. You can easily see how this formation got its name. It consists of the following: a strong rally, climaxing a more or less extensive advance, on which trading volume becomes very heavy, followed by a minor recession on which volume runs considerably lower than it did during the days of rise and at the top. This is the left shoulder. B. Another high-volume advance that reaches a higher level than the top of the left shoulder, and then another reaction on less volume that takes prices down to somewhere near the bottom level of the preceding recession, somewhat lower perhaps or somewhat higher, but, in any case, below the top of the left shoulder. This is the head. C. A third rally, but this time on decidedly less volume than accompanied the formation of either the left shoulder or the head, which fails to reach the height of the head before another decline sets in. This is the right shoulder. D. Finally, decline of prices in this third recession down through a line, the neckline, drawn across the bottoms of the reactions between the left shoulder and head, and the head and right shoulder, respectively, and a close below that line by an amount approximately equivalent to 3% of the stock's market price. This is the confirmation or breakout. Note that each and every item cited in A, B, C, and D of diagram 6.1 is essential to a valid head and shoulders top formation. The lack of any one of them casts in doubt the forecasting value of the pattern. In naming them, we have left the way clear for the many variations that occur. For no two head and shoulders are exactly alike, and have included only the features that must be present if we are to depend on the pattern as signaling an important reversal of trend. Let us examine them in greater detail. See figures 6.1 through 6.12. Volume is important. First, let us consider the matter of volume. It is always to be watched as a vital part of the total picture. The chart of trading activity makes a pattern just as does the chart of price. Diagram 6.1, a hypothetical daily stock chart. Price in the upper part and volume at bottom are drawn to show how an ideal head and shoulders top reversal formation would develop. A, B, C, and D refer to essential features listed on the previous page. Ranges. The two go together and each must conform to the requirements of the case. But note also that volume is relative. When we speak of high volume, we mean a rate of trading notably greater than has been customary in that particular stock during that particular period under examination. The exact number of shares traded is not important, and it will not ordinarily signify anything for our purposes to compare daily volume of, say, 6,500 shares in Radio Corporation with 500 in bone aluminum and brass. The former may be very low and the latter very high as judged by the proper technical criterion, which is, in each case, the average recent activity in the same issue. In the case of a head and shoulders top, as mentioned, high volume attends the making of the left shoulder. This means that activity on the rise to end at the top of the left shoulder should be greater than on the preceding rally waves in the same issue, followed by a minor recession on dwindling activity, and then a new advance on high volume. The action thus far does not differ from what we should expect of normal wave development within a continuing uptrend. In these respects, any two typical, successively higher waves in an advance may, as you can see, become the left shoulder and head, respectively, of a head and shoulders reversal. The first suggestion a head and shoulders is really developing may come when the volume record shows that activity accompanying the most recent top was somewhat less than the one preceding it. If this volume disparity is conspicuous, and if it becomes evident from the way prices are receding that the second and higher rally has ended, then the chart should be tagged with a red signal and further developments should be scrutinized. But such a preliminary warning does not always appear and should not be taken as conclusive when it does. Roughly estimated, about 1/3 of all confirmed head and shoulders formations show more volume on the left shoulder than on the head, another third show about equal volume, and the final third show greater volume on the head than on the left shoulder. Another warning, or, more often, the first comes when prices drop in the course of the second reaction, that is, from the head, below the level of the top of the left shoulder. Such action, as we shall see later on in our specific study of support and resistance levels, is significant of weakness in the price structure. So far it is minor, it may be only temporary, and it is certainly not conclusive. Nevertheless, when this occurs, put a double red tab on your chart. Breaking the neckline. The real tip-off appears when activity fails to pick up appreciably on the third rally, the right shoulder. If the market remains dull as prices recover, at which stage you can draw a tentative neckline on your chart, and if, as they approach the approximate level of the left shoulder top and begin to round over, volume is still relatively small, your head and shoulders top is at least 75% completed. Although the specific application of these pattern studies in trading tactics is the province of the second part of this book, we note here that many stock traders sell or switch just as soon as they are sure a low volume right shoulder has been completed, without waiting for the final confirmation named under D as the breaking of the neckline. Nevertheless, the head and shoulders is not complete, and an important reversal of trend is not conclusively signaled until the neckline has been penetrated downside by a decisive margin. Until the neckline is broken, a certain percentage of head and shoulders developments, perhaps 20%, are saved. That is, prices do not go lower, but simply flounder listlessly for a period of time in the general range of the right shoulder, then eventually firm up and renew their advance. Finally, in rare cases, a head and shoulders top is confirmed by a decisive neckline penetration and still prices do not go down much farther. False moves such as this are the most difficult phenomena with which the technical analyst has to cope. Fortunately, in the case of the head and shoulders, they are extremely rare. The odds are so overwhelmingly in favor of the downtrend continuing once a head and shoulders formation has been confirmed. It pays to believe the evidence of the chart no matter how much it may appear to be out of accord with the prevailing news or market psychology. One thing is worth noting about head and shoulders formations that fail completion or produce false confirmations, that is, such developments almost never occur in the early stages of a primary advance. A head and shoulders formation that does not work is a warning that even though there is still some life in the situation, a genuine turn is near. The next time something in the nature of a reversal pattern begins to appear on the charts, it is apt to be final. Variations in head and shoulders tops. There is a tendency, surprising when one thinks of all the vagaries of news and cross-currents that may influence day-to-day trading, for head and shoulders patterns to develop a high degree of symmetry. The neckline tends to be horizontal and the right shoulder tends to resemble the left in price confirmation, although not, of course, in volume. There is a sort of satisfying balance to the overall picture, but symmetry is not essential to a significant head and shoulders development. The neckline may slope up, from left to right, or down. The only qualification on an upsloping neckline is that the bottom of the recession between the head and right shoulder must form appreciably below the general level of the top of the left shoulder. It is sometimes said that a downsloping neckline indicates an unusually weak situation. This is so obvious that it is apt to be given even more weight than it deserves. A share of that excessive weakness, it should be noted, will have already been discharged by the time the downsloping pattern is formed and prices have broken the neckline. The measuring formula, which we shall discuss later, applies to such situations. Due to the tendency towards symmetry in shoulder development, some traders, as soon as the neckline has formed, will draw on their charts a line parallel to the neckline, extending from the top of the left shoulder through the head and on to the right. This furnishes a guide as to the approximate height the right shoulder rally should attain and, consequently, a selling level. But you will not see very many formations as perfect and symmetrical as our ideal picture, a fact the several actual examples accompanying this chapter amply illustrate. Either shoulder may, in fact, go higher or take more time than the other. Either or both may come up nearly to the level of the head, but not equal it, or else no head and shoulders exists, or both may fall considerably short of it. If activity attending the right shoulder is abnormally dull, that shoulder is apt to be low but protracted in time. In general, there seems to be a balanced relation between the three elements of price pattern, time, and volume that is practically impossible to express in words or figures, but comes with experience to sense and its development. However, there are no laws beyond those stated in our A, B, C, and D of diagram 6.1. Within those limits, look for an infinity of minor variations. Price action following confirmation, the measuring formula. The final step, the downside penetration of the neckline, may be attended by some increase in activity, but it usually is not at first. If volume remains small for a few days as prices drift lower, a pullback move frequently ensues that brings quotations up again to the neckline level, rarely through it. Normally, this is the last gasp. Prices then turn down quickly, as a rule, and break away on a sharply augmented turnover. Whether or not a pullback rally will occur after the initial penetration seems often to depend on the condition of the market in general. If the whole market trend is turning down at the same time as our individual issue, which has just completed its head and shoulders, there will probably be no pullback. Prices instead will tend to accelerate their decline, with activity increasing as they leave the vicinity of the top. If, on the other hand, the general market is still firm, then an attempt at a pullback is likely. Also, the odds seem slightly to favor a pullback if the neckline has been broken before much of a right shoulder developed, but certainly no sure rules can be laid down. In any event, the pullback rally is of practical interest chiefly to the trader who wants to sell the stock short, or who has sold it short and has then to decide where he should place a stop-loss order. Now we come to one of the most interesting features of this basic reversal formation, the indication that it gives as to the extent, in points, of the move that is likely to follow the completion of a Head and Shoulders. Measure the number of points down vertically from the top of the head to the neckline as drawn in figure 6.4. Then measure the same distance down from the neckline at the point at which prices finally penetrated it following the completion of the right shoulder. The price level thus marked is the minimum probable objective of the decline. Let us hasten to state one important qualification to the Head and Shoulders measuring formula. Refer back to our original set of specifications for a Head and Shoulders. Under A, we required strong rally climaxing a more or less extensive advance. If the up move preceding the formation of a reversal area has been small, the down move following it in fact, probably will be equally small. In brief, a reversal pattern has to have something to reverse. So, we really have two minimums, one being the extent of the advance preceding the formation of the Head and Shoulders and the other derived from our measuring formula. Whichever is the smaller will apply. The measuring rule is indicated on several of the examples that illustrate this chapter. You can see now why a downsloping neckline indicates a weaker situation than an upsloping neckline, and just how much weaker, as well as the fact that more than half of the minimum expected weakness has already been expended in the decline from the top of the head to the penetration of the neckline. The maximum indications are quite another matter, for which no simple rules can be laid down. Factors that enter into this are the extent of the previous rise, the size, volume, and duration of the Head and Shoulders formation, the general market primary trend, very important, and the distance that prices can fall before they come to an established support zone. Some of these are topics for later discussion. Relation of Head and Shoulders to Dow theory. Without doubt, some readers have already suspected the Head and Shoulders pattern is, in a sense, just an adaptation of the principles of Dow theory to the action of an individual stock. So it is. The decline of prices from the head to the neckline, the rally to the right shoulder, and then the ensuing decline that breaks the neckline set up a sequence of lower tops and bottoms analogous to those that signal a downtrend in Dow theory. This logical relation of the Head and Shoulders to Dow theory is another reason, in addition to its basic importance, frequency, and dependability, why we have placed it first in our study of reversal formations. But it also is more definite, gives advance warnings that are relatively easier to detect, and is quicker with its signals in the case of upsloping necklines. Moreover, it requires no specified minimum time for any of its component moves, and no confirmation by another stock or average. There are Head and Shoulders bottoms, an undescriptive term for a bottom formation that I would prefer to call the Kilroy bottom. See figure 7.4, as well as tops, with equally important implications. The bottom formations will be taken up in our next chapter.